Stop scrolling, because one quiet banking rule change in 2026 could freeze your paycheck, delay your bills, or flag your own money as fraud. And almost nobody is talking about it. If you use direct deposit, auto pay, or depend on your bank to protect you from scams, this video could save you real money. Stay with me till the end, because I'll show you exactly what's changing and how to protect yourself before it hits. And here's the part. Banks aren't explaining clearly. One wrong move on your account and your money can get held even if you did nothing wrong. Most people won't see this coming, but you will by the end of this video. Before we go any further, if you care about your money, your paycheck, and staying ahead of these quiet rule changes, hit subscribe. This channel isn't for everyone. It's for people who want real explanations without the confusing bank jargon, and who want to protect their money before problems happen, not after. Let's talk about something that might be flying under your radar right now, but could have a real impact on how you manage your money in the coming months. There's a new banking rule that's been approved, and honestly, it's part of a bigger picture of changes happening across the entire American banking system in 2026. Now, I know what you're thinking. Banking rules sound boring, right? But stick with me here, because this stuff actually matters for your everyday life, especially if you're someone who relies on automatic payments, direct deposits, or just wants to keep your hard-earned money safe from scammers. The thing is, the banking world is going through what experts are calling a major overhaul. And whether you realize it or not, these changes are going to affect how your bank handles your money, how they protect you from fraud, and even how quickly you can get your paycheck or government benefits. So, let's break this down in a way that actually makes sense without all the confusing financial jargon. First off, one of the biggest changes coming down the pipeline involves how banks monitor your automatic payments and direct deposits. You know those bills that come out of your account every month like clockwork. Your mortgage payment, your car insurance, your streaming services, maybe even your gym membership that you keep forgetting to cancel. Well, starting in March 2026, there's a whole new framework being put in place by an organization called NACHA, which is basically the group that governs the electronic payment system in America. Up until now, banks were mainly focused on watching the money going out of your account, what they call debit transactions, looking for anything suspicious that might indicate fraud or unauthorized charges. But the new rules are changing this in a pretty significant way. Now, banks are going to be required to monitor both the money going out of your account and the money coming into your account. That means when your paycheck gets deposited, when you get a tax refund, when someone sends you money, all of that is going to be watched more carefully by your bank's fraud detection systems. Now, you might be wondering why this matters. And here's the thing. This is actually designed to protect you. With the rise of really sophisticated digital fraud schemes, criminals have gotten incredibly clever at manipulating the banking system. They're not just stealing money from accounts anymore. They're actually tricking the system by making fraudulent deposits that later get reversed, leaving you on the hook. Or they're using compromised account information to route money through innocent people's accounts. By monitoring both sides of the transaction, banks can catch these schemes earlier and protect you better. But here's where it gets interesting for you as a regular person just trying to pay your bills and manage your household budget. This increased monitoring means that sometimes your bank might flag a legitimate transaction as suspicious. Let's say you normally get paid every other Friday by direct deposit from your employer, and suddenly you get a bonus payment on a Wednesday from the same company. The bank's artificial intelligence systems might see that as unusual and temporarily hold that deposit while they verify it's legit. Or maybe you set up a new automatic payment for a subscription service you just signed up for. And because it's a new merchant that your bank hasn't seen before, in your transaction history, they might pause it to make sure you actually authorized it. Now, this can be a little frustrating in the moment, especially if you're counting on that money to be available right away. But the flip side is that this system is also catching actual fraud attempts before they can drain your account. The key is understanding that this is happening and knowing that you might need to check in with your bank more often than you used to, especially if you're making changes to your automatic payment setup or if you're expecting unusual deposits. Another major change that's rolling out in 2026 has to do with how transactions are labeled in your bank account. Have you ever looked at your bank statement and seen something like XYZ CP 12345 and had absolutely no idea what you actually paid for? Yeah, we've all been there. And it's incredibly annoying, especially when you're trying to track your spending or figure out if a charge is legitimate or fraudulent. Well, the new rules are requiring companies to use standardized descriptions that actually make sense to human beings. Starting in March, any payment related to your wages or salary has to be clearly labeled as payroll in your bank statement. If you buy something online, it needs to be labeled as purchase, so you can immediately see that it's a shopping transaction. This might seem like a small thing, but it's actually huge for a couple of reasons. First, it makes it way easier for you to manage your budget and understand where your money is going each month. You can glance at your statement and immediately see, okay, that's my paycheck. That's the thing I bought on Amazon. That's my utility bill. But secondly, and this is the part that's really important, it makes it much easier for both you and your bank's fraud detection software to spot transactions that don't belong. If you suddenly see a charge labeled purchase from a company you've never heard of, you know right away that something's wrong, and you can report it to your bank immediately instead of spending hours trying to figure out what that cryptic code might have been for. Now, let's talk about what happens when you do spot a fraudulent charge or an automatic payment that you didn't authorize. The rules around how quickly you can stop these payments and get your money back are changing too. And this is actually great news for consumers. In the old system, you might notice a pending charge on your account, something that's been initiated but hasn't officially posted yet. And you'd call your bank to say, hey, I didn't authorize this. But the bank would often tell you they couldn't do anything until the transaction actually completed and the money left your account. So you'd have to wait sometimes several days watching this unauthorized charge sit there in pending status. And then once it finally posted, you'd have to file a claim, wait for an investigation, and eventually get your money back. But in the meantime, that money was gone from your account. The new rules changed this pretty dramatically. Banks are now allowed to file what's called a written statement of unauthorized debit, or WSUD for short, as soon as they see a pending transaction, even before the money actually leaves your account. This means that if you catch something early and report it right away, the bank can potentially stop the payment from ever going through in the first place. You're not sitting around waiting for your money to disappear and then trying to get it back. You're actually preventing it from leaving in the first place. This is a huge win for people living on tight budgets, because even a few days without access to a couple $100s can mean missed payments on other bills, overdraft fees, and a whole cascade of financial problems. There's also a really important new provision specifically designed to help people who've been victims of what's called social engineering scams. These are the really nasty types of fraud where criminals don't hack into your account or steal your debit card. Instead, they trick you into authorizing a payment yourself by pretending to be someone they're not. You've probably heard about these. The scam where someone calls pretending to be from the IRS, saying you owe back taxes and need to pay immediately, or you'll be arrested. Or the one where someone claims to be your grandchild, calling from jail and desperately needing bail money right now. Or even the tech support scam, where someone says your computer is infected with viruses and you need to pay them to fix it. These scams work by creating a sense of panic and urgency that makes people act without thinking, and they've become incredibly common and sophisticated. The problem with these scams under the old rules was that because you technically authorized the payment yourself, even though you were lied to and manipulated, banks didn't have a lot of options to help you get your money back. The new 2026 rules create a specific legal definition for payments made under what they call false pretenses, and they give banks more tools and responsibilities to help recover your money if you were tricked into making a payment based on lies. Now, this doesn't mean you're automatically guaranteed to get your money back in every case. Fraud recovery is complicated, and sometimes the money is just gone. But it does mean that banks have to take these cases more seriously and make a real effort to track down the stolen funds and communicate with other banks to try to reverse the transaction. This is a recognition that consumers who fall victim to these sophisticated psychological manipulation tactics aren't just being careless, they're being deliberately targeted by criminals, and they deserve some protection. Speaking of scams and fraud, let's talk about something that affects millions of Americans, especially retirees and people on fixed incomes, and that's the big push away from paper checks for government payments. The U.S. Treasury has been aggressively phasing out physical checks for things like Social Security payments, veterans benefits, and tax refunds. And by 2026, if you're still relying on getting a paper check in the mail for your federal benefits, you're going to be pretty much forced to switch to electronic payments. Now, the government's reasoning for this makes sense from a security standpoint. There's been a huge increase in mail theft, where criminals are literally stealing checks out of mailboxes, washing them to remove the original information, and then rewriting them to themselves for thousands of dollars. By moving everything to direct deposit or prepaid debit cards, the Treasury is trying to protect people from having their benefit checks stolen. But for a lot of folks, especially older Americans who aren't as comfortable with online banking and digital payments, this transition can feel overwhelming and scary. If this affects you, the important thing to know is that you're going to need to have a bank account set up to receive direct deposits, or you'll be given a prepaid debit card that the government loads your benefits onto each month. And here's where the new monitoring rules we talked about earlier come into play, because now you're going to need to be more diligent about checking your account regularly to make sure those deposits are coming through correctly. The set it and forget it approach that a lot of people used with paper checks, where you just wait for the check to show up in your mailbox each month, isn't really an option anymore. You need to be checking your account, whether that's online, through a mobile app, or by calling your bank's phone system to verify that your money arrived safely and that there aren't any unauthorized charges. Another development that's happening in the background of all these consumer-focused changes is the expansion of instant payment systems. The Federal Reserve has been rolling out something called FedNow, which is a service that allows money to move between banks instantly, 24 hours a day, 7 days away, 365 days a year. In the old system, if someone sent you money on a Friday evening, you might not see it in your account until Monday or Tuesday, because banks didn't process transfers over the weekends. With FedNow and these instant payment systems, that money can hit your account in seconds, even if it's the middle of the night on a holiday. This sounds great, and in a lot of ways, it is. You can get paid faster. You can send money to family members in emergencies, and they receive it immediately. And businesses can manage their cash flow more efficiently. But there's a flip side to this too, which is that fraud can also happen instantly. If a scammer gets access to your account information, they can potentially drain your account in minutes rather than days, which gives you and your bank less time to catch it and stop it. This is part of why all these new monitoring and fraud detection rules are being put in place, because the speed of the payment system has increased so dramatically that the security measures need to keep pace. For you as a consumer, this means being even more careful about protecting your banking information, using strong passwords, enabling two-factor authentication on your bank accounts, and being skeptical of anyone who asks you to provide account details or authorize payments, even if they claim to be from your bank or a government agency. There's also been some changes happening with overdraft fees, which is something that affects a lot of Americans. If you're not familiar with how overdraft fees work, basically if you try to make a purchase or pay a bill and you don't have enough money in your account to cover it, the bank can either decline the transaction, which is embarrassing, but doesn't cost you anything, or they can go ahead and approve the transaction anyway, and then charge you a fee for covering the difference, which is usually around $35 per transaction. These fees have been a huge source of revenue for banks, but they've also been criticized as being predatory, especially because they disproportionately affect people who are already struggling financially. There was a rule that was supposed to go into effect that would have capped overdraft fees at $5 for large banks, which would have saved consumers billions of dollars every year. But that rule got overturned by Congress before it could take effect. However, California decided to go ahead with its own version at the state level, capping overdraft fees at $14 for state-chartered credit unions. Though, this doesn't apply to the major national banks operating in California. So, depending on where you live and what kind of financial institution you bank with, you might see some relief on overdraft fees, or you might still be dealing with the same old expensive fees. The best advice here is to check with your specific bank about their overdraft policies and consider opting out of overdraft protection altogether, which means your transactions will just be declined if you don't have enough money instead of being approved with a big fee attached. All of these changes are happening against a backdrop of broader shifts in banking regulation. The current administration has been pushing for what they call a more innovation-friendly approach to banking, which in practice means making it easier to start new types of banks, being more open to cryptocurrency and digital asset companies accessing the banking system, and generally reducing what they see as unnecessary regulatory burdens on financial institutions. This is a pretty significant change from the previous administration's approach, which was more focused on strict oversight and making sure banks weren't taking excessive risks that could lead to another financial crisis. Now, whether you think this shift toward deregulation is a good thing or a bad thing probably depends on your perspective. Supporters argue that it will lead to more competition, more innovation, better services for consumers, and easier access to banking for people and businesses that have been shut out of the traditional system. Critics worry that loosening regulations could lead to more risk-taking by banks, potentially setting the stage for future financial problems, and that reduced oversight might mean less protection for consumers when things go wrong. The truth is probably somewhere in the middle, and the real impact won't be clear for several years, but it's worth paying attention to because it affects the stability and safety of the entire banking system that holds your money. One specific area where you might see the impact of these regulatory changes is in the availability of banking services for certain types of businesses. There's been a lot of controversy about something called debanking, which is when banks refuse to provide services to certain customers or close their accounts, often because the bank views them as too risky from a regulatory compliance perspective. This has particularly affected businesses in industries like cryptocurrency, cannabis, in states where it's legal, or firearms, where banks have sometimes decided it's just easier to avoid those customers entirely rather than deal with the complex regulations around those industries. The new administration has issued executive orders directing banking regulators to stop what they view as politically motivated debanking, arguing that legal businesses should have access to banking services regardless of what industry they're in. For most regular consumers, this won't affect you directly, but it's part of this larger trend toward making the banking system more accessible and less restrictive. There's also a really significant change coming for how you can access and share your financial data, which is called open banking. The Consumer Financial Protection Bureau finalized a rule that requires banks to let you easily transfer your financial information to other providers if you want to switch banks or use third-party financial apps. The idea is that you should own your financial data, and if you want to move from bank A to bank B, or if you want to use a budgeting app that connects to your accounts, the bank should make that process easy and secure rather than making it difficult to leave. The largest banks have to comply with this rule starting in April 2026, with smaller banks having until 2030 to get their systems ready. This is potentially a big deal because it could make it much easier to shop around for better banking services, compare different banks' offerings, and switch to a competitor if you're not happy with your current bank. Right now, the hassle of moving all your automatic payments, updating all your direct deposit information, and transferring everything over is often enough to keep people stuck with a bank they're not thrilled with. With open banking, that process should become much smoother. The privacy protections built into the rule are also important. They're designed to prevent third-party companies from using your financial data for purposes you didn't agree to, and they're trying to move away from a risky practice called screen scraping, where you basically give your bank password to another company and they log into your account to grab your information, which obviously creates huge security vulnerabilities. Now let's talk about interest rates for a minute, because that's another factor affecting your bank account in 2026. The Federal Reserve, which is basically America's central bank and controls the overall direction of interest rates in the economy, has been lowering its benchmark interest rate, and they're expected to continue making small cuts this year. This has a direct impact on how much interest you earn on your savings and how much you pay on loans. If you opened a high-yield savings account back in 2024 when rates were really high, you've probably noticed that the interest rate you're earning has been creeping down. Some savings accounts that were paying over 5% annual interest are now paying closer to 4% or even less. This is a natural result of the Federal Reserve lowering rates. And while 4% is still pretty decent compared to historical standards, it's worth keeping an eye on. You might want to consider moving some of your savings into a certificate of deposit or CD, where you lock in a rate for a specific period of time, or looking into investment options that might offer higher returns, though of course those come with more risk. On the flip side, if you have loans with variable interest rates like credit cards or adjustable rate mortgages, you might see those rates come down a bit as well, though probably not enough to make a huge difference in your monthly payments. So, what does all of this mean for you in practical terms? Well, the bottom line is that 2026 is shaping up to be a year of significant change in how banks operate and how they interact with your money. The new fraud monitoring rules mean your bank is going to be watching your account more closely, which is mostly good because it helps protect you from scams. But it also means you might occasionally have legitimate transactions flagged or delayed. So, you'll need to stay on top of your account and be ready to verify things with your bank if needed. The clearer transaction descriptions are going to make it easier to understand your bank statements and spot fraudulent charges quickly. The new rules around stopping unauthorized payments before they complete could save you a lot of headaches and financial stress if you catch something suspicious early. If you receive government benefits, you need to make sure you're set up for direct deposit or have your prepaid card ready, because paper checks are basically going away. If you're someone who struggles with overdraft fees, check whether your state or your specific bank has implemented any fee caps and consider opting out of overdraft protection to avoid those charges altogether. The open banking rules mean you'll have more freedom to switch banks or use financial apps without as much hassle. So, it might be worth shopping around to see if you can get better service or better interest rates elsewhere. And finally, keep an eye on the interest rates you're earning on savings and paying on loans, because those are going to continue shifting as the Federal Reserve makes its decisions throughout the year. The big picture here is that banking is becoming more digital, more automated, and in some ways more complex, but also potentially more secure and more consumer-friendly if these new rules work the way they're supposed to. The key to navigating all these changes successfully is staying informed, checking your accounts regularly, being cautious about protecting your personal and financial information, and not being afraid to ask questions when something doesn't make sense. Banks are required to explain these changes to their customers. So, if you're confused about something or notice something different about how your account is working, reach out to your bank and ask for clarification. Most banks have customer service representatives who can walk you through what's changing and how it affects you specifically. And remember, while some of these changes might seem inconvenient at first, most of them are ultimately designed to make the banking system safer and more transparent for consumers like you. It's worth taking a little time to understand what's happening and adjust your financial habits accordingly, because at the end of the day, it's your money and your financial security that's at stake. These banking rule changes are real. They're happening now, and they're going to affect how you interact with your bank throughout 2026 and beyond. So, it pays to be informed and prepared.